Today we're going to talk about market strategies. We've talked about this in a previous video, but we're going to talk about this in a different way today through a series of 3 stories. I'm going to tell you a story from early in my career at a previous employer. I'm going to tell you a story about the 2008 financial crisis, and I'm going to tell you a story about something we just did last year with interest rates. And hopefully one of these stories will resonate with you, or maybe they all will, depending on how long you've been in the markets. We've seen a lot of stuff written. You've seen a lot of stuff talked about with the traditional 60-40 model. What a lot of advisors do is they talk about the 9 style boxes. You've got growth, you've got income, you've got large cap, small cap, large cap growth, small cap growth, large cap value, small cap value, and on and on and on. And they'll talk about stocks, and they'll have the 13 economic sectors, and they're benchmarking to the S&P 500. And they're going to have so much in each of the different economic categories to try to help you outperform the market by using tactical money management and moving money back and forth. The reality, not a lot of tactical decisions really ever get made. So early in my career, I was on an asset selection committee, and we managed a lot of money, and we managed it in individual stocks against the S&P 500 as our benchmark. So we had it broken down at that time into 13 different economic sectors. And each of those sectors, we had to be invested plus or minus 3%. So if a sector was 20% of the market, we could be invested as low as 17% or as high as 23%. But we could never invest less, and we could never invest more. I remember sitting in a meeting one day, and it was right before I left, because this was kind of the final straw that pushed me over the edge. We were talking about a sector. It was a telecommunications sector. Stocks like AT&T and Verizon and SBC and all the great baby bells. And our analyst that was presenting to us didn't like any of them. Pricing wasn't good. The valuations weren't good. There was a lot of pricing pressure, paying a lot of money to acquire clients and customers, and there just really wasn't anything good going on. Everything he said made me want to sell the sector and just get out of it completely, even short it if we could, which we weren't allowed to do. But instead, we were deciding whether we should have a buy or a hold on a lot of these names because we had to be invested in that sector somewhere. And so we were actively investing in things that we thought could go down because we had to be invested there. It just didn't seem like a great strategy to me to be forced to buy something just because the market's invested in it. So it was really refreshing when I joined Paragon in 2006 to have the ability to do what we thought was in the best interest of our clients. At that time, Paragon only invested in stocks, bonds, and cash, very similar to a lot of other money managers. But what we did do was we would actually look at the markets from a strategic standpoint and try to figure out where the best place that our clients could be invested. I remember back in 2007, we were sitting around our conference room table and we were talking about the financial sector. At that time, there was a lot of stuff going on with derivatives, with collateralized buyouts, with mortgages, and a lot of the bank's books were really muddy, really hard to kind of figure out what was going on. We always like to come up with 3 catalysts of what we thought would make a stock go up and 3 risks of what we thought could make a stock go down. But we couldn't come up with the risks because we couldn't understand what was going on with these financial statements of these banks. And the financial sector was like 20% of the S&P 500 at that time. So it was a huge part of the market. We made a decision to sell everything. We sold all of our financial stocks. We sold all of our preferred stocks, and we sold all of our financial bonds. We just got out of it completely. The last one that we're going to talk about, the third situation, was looking back a couple years ago. In 2021, our Federal Reserve Chairman, Jerome Powell, told us over and over and over again that interest rates, he was going to raise them to help combat inflation. By raising interest rates, he wanted to lower inflation down to a target of around 2%. He said he was going to raise interest rates 6, 7, 8 times in 2022 and maybe more. But the market either didn't believe him or just decided there was nothing they could do about it because most people were invested 40, 50% in fixed income. So what we did here was we looked at our clients and said, there's got to be a better way because when interest rates go up, bond prices go down, and we knew the bond market wasn't going to do very well in 2022. In fact, if you look back at 2022, the aggregate bond market, which is represented by an index called the AGG, went down almost 14% for the year. Stock market was down almost 18%. It was the first time in history we saw both stocks and bonds down double digits in the same year. But what we had done is we got almost all of our clients out of bonds. We had less than 3% of our total portfolio in traditional bonds at the beginning of 2022. We had shifted them into income-producing alternative bond products like callable yield notes and private credit. And those were yielding positive returns in 2022 and really helped a lot of our clients to generate income in a very low income environment. It helped a lot of them with their financial plan in which they were trying to generate enough income in retirement to not have to touch their principal. If this is something that seems of interest to you and something maybe you're not getting from your current advisor, we'd love to sit down and talk to you about how we can help you and open up a lot of different possibilities of different ways to invest money besides just the plain vanilla 60-40 portfolio. I'm Craig Navor with Paragon Capital Management. Reach out to us.